Hey guys, Greg Silverman here, CIOs, another episode of Come Learn With Me by London Bridge. Okay, come learn with me. Another interesting article you'll like and share it, and let's take a look by the NASDAQ. A record pace for IPOs. This is from January 14th, so a few days ago. Full Macintosh. Who would have thought a year with a recession caused by a pandemic would also have one of the strongest IPO markets in decades? But it did. Data shows that IPOs generally fall in the months of dramatic sell-offs, but usually recover once volatility normalizes. Last year followed the trend again, with a strong V-shaped recovery in the IPO market that made 2020 a record year for IPOs. This is a good data point. Data shows IPOs generally fall recover once volatility normalizes. So by the way, once I highlight these and once I post this out there, you'll find all my notes just below this video. So you can just really read the article in 4 or 5 sentences and get the gist of it if that's what you want to do. Total new listings at 1999 levels. I remember that. Although the IPO market stalled in March as the broader economy shut down, access to capital remained important. In fact, during the turmoil, Moderna raised an additional $1.34 billion to help accelerate important vaccine research. As the economy started to recover, IPO activity also picked up quickly. We finished 2020 with 479 IPOs, a level not seen since 1999, according to data from Professor Jay Ritter. Well, we know what happened in 1999, didn't we? So the count of IPOs. That only goes back to 2008. That's NAMEC, New York, ARCA, Amex, okay, so the US. Wow, the year 2020. Once again, NASDAQ led US exchanges with 316 IPOs, representing an 83% win rate for operating companies and 52% of all capital raised. Well, this is written by NASDAQ. Overall, IPO raised $155 billion in 2020, almost double the next best level since the credit crisis, where $88 billion was raised in 2014 across 309 listings. With the reduction in buybacks, Bloomberg estimates 2020 was the first year with an expansion in equity supply in a decade. However, with trading of $479 billion in corporate stocks every day, that increase in supply wasn't enough to stop prices from rising. Raised by distinction. Some sectors that are hotter than others. Given what an unusual year 2020 was, it's interesting to see what industries needed to raise capital. Not surprisingly, the data shows that healthcare companies account for almost 1/3 of all new capital raised by companies. We also saw a higher proportion of capital raised by consumer companies than any year since 2010, adding to around a quarter of all capital raised. But your consumer companies, so maybe, I'm not sure, what are those? Consumer good companies, or the Amazons of the world? Somewhat surprisingly, the allocation of capital raised by tech was down significantly from recent years. Interesting. Our records also show that there were no IPOs in the energy sector despite a late rally green energy ETFs as the election neared, fueled by a Democratic proposal to invest in that sector. Okay. Down significantly from recent years. That does surprise me. Our records also no IPO in the energy sector. Well, I mean, aside from green energy, the energy sector was, wow, look at that. Okay, specs. I'm sure I'm going to talk about specs now. 23% consumer discretion, consumer. Don't know what that defines. It has consumer discretionary and consumer staples there. All right. The other trends that clearly stand out is the increase in special purpose acquisition companies, or SPACs. SPACs are only shell companies. They raise capital in order to search for private companies that it will bring public in the future. Hence, us showing them above the 100% raised line. Okay. Yeah. Okay. Let's just get that in. Although SPACs have been growing over the past 5 years, last year they represent nearly 50% of all capital raised by operating companies, with more than 70 billion in proceeds raised. Because SPACs are typically smaller than operating companies, they account for more than half of all new listings. Wow. A lot of money went to SPACs, huh? Types of IPOs. We got SPACs, other. Alternate ways to list, SPACs and direct listings. SPACs and direct listings were both popular last year. They both represent ways to bridge the gap between private equity and a traditional IPO, and neither requires an extensive roadshow because the capital is already there. With so much of the country working from home and experts advising against travel, the growth in SPAC and direct listings may partly represent a practical solution to COVID-19. That's interesting. Yeah. This has come despite SEC changes that loosened accredited investor rules, allowing more investors to buy private companies. In contrast, being listed on public exchanges, SPACs allow anyone with a brokerage account to benefit from emerging companies. The SPAC managers bringing private companies public and realizing the liquidity premium. Good article. It's interesting. IPOs also performed strongly this year. Not only was it a strong year for capital raising, but IPOs also performed unusually well. Over the past 10 years, an average of 24% of IPOs had negative first-day returns. However, this year, only 21.5% of IPOs closed their first day of trading below the offer price. The price paid by early investors allocated stock the night before the IPO started trading. That's also evident from the average day one return of 38%, well over the normal IPO premium. Yeah. And look at that. Up there, Airbnb, Snow, Dash, there's the average. Cool. It wasn't just one-day returns that was, look at this. All right. It wasn't just day one returns that were strong this year. If we look at IPO ETFs, they mostly acquire IPO companies after they've started trading. So they don't capture the liquidity premium from listing. Okay. Despite that, they also outperformed the market. The Renaissance IPO ETF, ticker IPO, ended the year up 107%. Our First Trust's US Equities Opportunities ETF, FPX, rated 47%. Cool. So big returns. The Renaissance IPO, 100. Grab that one. Even after accounting for the volatility in the underlying indexes, the risk-return ratio of both IPO indexes were better than the broader market. An unexpected year on many levels. Despite the coronavirus pandemic, 2020 was an unexpectedly strong year for bringing companies to market. Because of COVID, it seems the attraction of alternate low-contact ways to bring private companies public also thrived. Right. The strength of U.S. listed markets is good news for U.S. investors, most of whom can't participate in the early stage gains of private companies. Not all countries have been so lucky in 2020. So this also reflects how not all countries had. Okay. So this also reflects how attractive U.S. markets remain as a place to raise capital, as well as how the U.S. economy is able to adjust quickly to find opportunities even in the midst of a pandemic. Yeah, definitely like that. How the U.S. economy is very robust and able to change. All right, guys, great article. You can catch the bullet points below. Very interesting, huh? Healthcare being the biggest contributor to raising capital, and then consumer, which we're not quite sure what it was, and SPACs were a big winner. Okay, take care. Bye.